Okay, guys, welcome to the Red to Black podcast today with your hosts, Warner and Mario. And today we're discussing medical mandates in Bitcoin and NFTs and the euphoria that's overtaking the markets. It's really, guys, it's pure insanity. And I want to start off with Bitcoin NFTs and what I'm seeing in those markets. What I'm really seeing is the most insane amount of insanity and euphoria I have ever seen in my life. And I've only been around this earth about 42 years, but from researching past sort of the tulip ball, Mississippi crisis, all this other stuff, Roman Empire, we are at a point where we're just at catastrophic euphoric levels. And there's one reason why. It's because of technology. Nowadays you can start a business, you can buy a business, you can run a business, you can invest in a business, you can do all those things. In the past, you could really only focus on one, but because of technology, it's brought everything together. And it's created this environment where you can just get into an NFT like that or get into a Bitcoin. And you hear a guy saying, like, I've heard this German guy on ads on YouTube say, basically, he said, if you use the old school way of making money, you may make money by 70 or 80. There's no chances that you will. You probably won't. But if you follow my 7-step process in Bitcoin, you'll definitely make money. You'll do it at an early age. I was like, that's insane. Mario, what are your thoughts?
You hit the nail on the head, Warner. When I first bought a couple shares of Boeing, I had to physically get a ride down to Bellevue from one of my parents, walk into an office building and fill out a sheet for a stockbroker to buy me a couple shares of Boeing. Now you can take your stimulus check and leverage it over the internet and buy a digital ledger. I want to stop calling it what they say it's a coin. I'm going to call it a ledger. I'm going to call it what it is. These are digital ledgers. It's a digital recording. It's not a coin. There's no physical coin, so we're going to call it a ledger. But that's what's happening is you're able to take your stimulus checks and in the click of a button or on your phone, buy these worthless transactions that are basically ledgers. That's where we're at. That's the reality. That's where we're at. We're at this hyper bubble, this multi-dimensional hyper bubble of folly that's going to explode and people are going to jump out of windows. It's sad. That's how these bubbles end and this is at the extreme end of a bubble. We have a 12-year, 15-year bubble in real estate, in equities, and now in these digital ledgers. And it's sad. It's going to end with death.
And a few interesting things that I've been listening to, some guys on Stansberry Research, I forget their names, but Danielle Carbone, she's a really good interviewer. She interviews a lot of great financial minds. And these two guys in particular, they really seem to know what's going on with Bitcoin. And they both are saying the same things. They're saying that Bitcoin trades more like a tech stock. So meaning, like, if the market goes down, it actually goes down more. They're saying 2 to 3 times more than if a tech stock or the market goes down. And why that's interesting, because I've talked about this before with Mario, is if you're looking for a store of value, say like gold or real estate or something else, you want to look at who's going into it at the time, because who's ever going into it at the time is going to influence the price, whether it goes up or down. So if you look at Bitcoin right now and you look at the mindset of most investors, like, just go on Twitter or YouTube and look what most people are saying. They're not talking about Bitcoin as a store of value. They're kind of saying it's a store of value, but it's like a caveat. What they're really saying is you can make a ton of money. Oh, caveat, it's a store of value. It's not a store of value. So what happens is, like in 2008 and other crashes, when things start deleveraging, margin calls, like prices start dropping, and whoever you're leveraged with, who's ever loaned you the money, goes, oh, I'm margin calling you. You have to come up with that money. If that's in a stock account, well, you're going to go to Bitcoin to execute on your trades. Also, another point that people have pointed out is that a lot of retail traders are in the stock and Bitcoin markets. And another individual pointed out this really important fact, that as inflation goes up and up and up, a lot of these individuals, that's their money to live on. So what do? They start executing trades, driving the price down. Not only is that an issue, but also like when these things start deleveraging, like these tech markets start deleveraging, everyone's going to start coming out of Bitcoin and these stocks. And as people are coming out, other people are going to go, oh, I don't want to lose my money. And they come out. It's self-reinforcing. It just keeps going boom like this, like tumbleweed down. And what people will find at the end of this all, and we've talked about this, Mario, it's like Warren Buffett said, we'll see who's wearing their shorts when the tide goes out. You'll see what the fundamental assets are that provide value. And how can you tell? Mario and I look for businesses that are supported by the consumers of the business, meaning they buy a product and there's a delta between the cost of the product and how much the product sells for, and that's the profit the company makes. And then some companies run on the debt and equity markets. When things crash, those companies are all gone. The companies that are around are the companies that actually provide value. So look at the next crash, it's like a clearing. It's like a wave coming through. That's why Warren Buffett's analogy is so apt. The wave comes through, and then you see who's left.
Yeah, things are about to drastically change. The stimulus money is drying up. It's almost completely over. That money flowed into AMC stock. It flowed into GameStop. It flowed into Bitcoin, Ethereum, Dogecoin, and now it's drying up. And now what we have is these leveraged positions of what they have some sort of value that they can leverage if things go in their favor. But as soon as there's a change in the tide. And the tide, right now it's at slack tide. If we want to use a naval term, it's at slack tide, and it's going to be an ebbing tide. It's going to flow out. So we have a flood tide, a slack tide, an ebb tide, and what's happening is you can't get out fast enough. You can't run for the exits fast enough. So it goes down, it crashes, and people lose their homes, their cars, their boats, their RVs, their toys. It's going to get ugly. This sickness, transition a little bit, and I also want to know what's going on in LA since you're at UCLA, but this sickness is also going to create the same selling. I mean, forced sellers. There's no greater forced seller than a dead dude.
Go ahead.
And
what's interesting before we transition to that is what people don't realize is this environment has been created by these low interest rates. I think the interest rate should be 6-7%. Promotes saving, promotes.
Well, they should be commiserate with the rate of inflation, which is 15 to 18 to 20%.
But I'm saying once we've worked that all out, I think that interest rate should be 5, 6,
right,
7%.
Sure. Well,
so what you do is you get this environment.
I'd like to see them. Here's how the most stable monetary policy we could have is that we would set the interest rate to like the 10-year bond and the growth of the money supply at the rate of our population growth, our organic population growth, not open borders, not immigration, our organic growth. What is the percent of our growth? Is it 3%? Cool. Our money supply is going to grow at 3%. Our 10-year bond is going to be at 3%. We're going to target the rate of growth in our population with the money supply and the 10-year bond yield, U.S. Treasury bond yield, 10%, 10-year. That would be very sustainable.
And what it would also do is we've talked to this before. When you have a bunch of cash in your hand, like I bought some assets recently, you think about, like they asked me at the dealership, hey, do you want this insurance policy? And if you were taking out debt on it alone, you'd be like, oh yeah, just throw that in. Throw in the extra 5-year warranty is what it was. Yeah, just throw it in. But I said
right. On a loan, because you're looking at a couple dollars a month, in your payment difference. Sure, throw it on. But when you're paying cash, like, do you want to spend $5,000 extra in cash? No.
Yeah, exactly.
No,
so that's the exact point. That's the challenge, and you just stated it right there with a loan versus cash. The loan makes the payment look really small. The cash, the payment's actually what it is, and what that does, as we've talked about before, is it takes that purchasing from the future and it draws it back to the forward. Now, what's happened is because interest rates are so low, and there's actually negative real interest rates. If you look at the inflation and you look at the interest rate, we actually have negative real interest rates, and people don't realize it. But what's happening is it's like a risk-on environment. So that's why you see all this money going to NFTs, Bitcoin, unprofitable stocks, right? You see all this money flooding in. So what's happening is they're creating this environment, the Fed, where all this money is flooding into unproductive assets. And once all those unproductive assets, we've talked about this, they come out of the market. Now you have this massive vacuum. I mean, massive vacuum where the people don't have jobs. They're not working. Everything's destroyed. And And the challenge with going to what you're saying, the challenge of the current environment going forward, it's like there's no way to reset because you have these medical mandates. So it's like it's done, and now you've created maybe a bartering economy or some sort of other economy, but now you've created a explosion of debt deleveraging, but now you can't even get back up to speed because of what you were talking about, which is medical mandates preventing you from working.
Yeah, it's not that we go back to 2019 when we reset, when we have to reset everything. It's not like, well, we'll just go right back to 2019 and reset from that point. No, it can be, if you look back in history, it could take 30, 40, 50 years for the stock market to return to where it was in 2019. When this thing actually tanks and goes all the way down, to go back up, it can take decades and decades. And you can become an agrarian economy. You can go way back. You can reset your culture and your priorities way back when you have a currency collapse, when you have a governmental collapse. It can get real ugly. So just extrapolating the numbers. So the CEO of One America came out with a interview, and they wrote a Zero Hedge article on it. But he's saying there was a 40% increase in the death of 18 to 64-year-olds, which is like above a 200-year event. So if it was about 10% increase in the death rate, you would see a 1 in 200 year would be a 10% increase. And this is something way off the charts. This is about the third most deadly pandemic we've ever had. Might be the fourth, depending on, how bad this gets, or it could be the third. Right? Correction, depending on how bad this gets, right now it could be the third or the fourth. The two largest pandemics the world has seen in the recent, last couple thousand years are the 1918 sickness, which 50 million people globally died. 50 million. That resets a lot. That's a lot of. There is no greater forced seller than a dead dude. That's the definition of a forced seller. All shares have to be owned by someone at all times. All real estate is owned by someone or something at all times.
I didn't think about.
Go ahead.
That's interesting, because we were talking about this the other day, and I didn't put those two together: the deleveraging of the debt, and then now there's also another deleveraging because people are no longer around. And then there's also a tax implication, because now, well, if this guy's an elder individual and he's got an estate set up, or he doesn't, but those shares have to be sold off, now there's a forced selling on that point. It's just all over the place.
There's forced selling, whether it's an 18-year-old, 18 to 16-year-old, even an 18-year-old, he still has a pickup truck. He still has a motorcycle. There's still assets that 18-year-old no longer, it's inappropriately position. Someone has to own that motorcycle. Someone has to own that pickup truck.
Shares of stock. They don't know what to do with them, so they just sell them.
Someone has to own all shares at all time. The shares don't sit without an owner. Someone owns the shares at all times. So you have a deleveraging and you have death, an increase in the normal rate of death that's exceeding the birth rate. We have depopulation occurring right now. And then the big one was, I'm not going to mention the name of this, so the algorithm blocks us, but between 1347 and 1351, a 4-year period, mostly in Europe, 75 million people died. That's the low end. Which sounds, well, it's, from 50 million in 1918 to 75 million. Okay, 25 extra million. It's a lot, but okay, that's the range we're dealing with. But the population at that time was 450 million people. So that's 16% of the population on the low end. They said on the high end estimate was about 200 million people died, which is about 47% of the global population. So if this thing is just equal to where we've had pandemics in the past, going back not thousands of years, a couple hundred years, or several hundred years, you could see between 16 and 47% of the population dead, which puts the number somewhere around 3 billion people. If you extrapolate the current statistics out 10 years, you have 3 billion people perishing from this sickness. That is an enormous amount of forced sellers.
It's gonna get insane. I mean, I'm in LA right now, and the what I'm seeing on the ground is I'm seeing what I saw during the beginning of the sickness. It's really quiet. Um, there's just it just seems dead. It doesn't seem like LA that I knew before 2019. It's like death came over it. And I'm not doing this to be a fear monger, but it's death came over it. And what I'm noticing driving around, I mean, there's for lease signs. I mean, everywhere. I mean, I'm not exaggerating. I mean, literally
No, I saw them I saw, not only are they everywhere, but they're in the best of the, I mean, you got the best real estate in the world and it's for lease. You can't find a tenant for the best quality real estate. I'm driving through Montecito outside of Santa Barbara, the lower village in Montecito. You get off of it's, I mean, it's a block from from the 101. It's a block from 101, Montecito Lower Village, and there's a vacant corner retail, 5,000 square foot retail space. That could be a car dealership. It could be a Ferrari dealership, Lamborghini deal. I mean, it could be high end. And you're like, they can't find a tenant for Montecito
yeah.
real
I mean, the
estate.
challenge is it like this guy named Gerald Salente talked about the office occupancy rates, like 40% occupied. So I'm looking at building vacants,
So
across the country,
60%
and then
vacancies.
70%.
And that has to support the debt and then try to give a on top of the debt, try to pay the pension, whoever owns it, the pensioners that own this, the funds that own this, the real estate investment trusts that own this, the investors, small mom and pop investor, syndicates that own this real estate. You're trying to pay your debt and pay your
And then
investors
you
off
see,
of
and
40%
you see all
occupancy.
these office buildings going
Doesn't
up
work
in
out.
LA, and it's crazy, man. Yeah,
They're building.
but
They're
I think
building
we
office
can,
buildings.
yeah,
Yeah, one more last thing. I told you kind of what I saw leaving LA. I came up to see you and Lydia and the boys, and I'm driving through, I think, the largest section of I-5 widthwise. I think it's 7 lanes each way, driving just outside. So it'd be just east
yeah.
of Long Beach or LAX. It widens out to 7 lanes, and when there's traffic, you go, okay, that makes sense. When there's a bunch of cars going through that space of 7 lanes, 14 lanes wide, so 7 going north, 7 going south, it makes sense. The freeway was, I mean, a ghost town, literally. I mean, I'm just driving. It's a Saturday driving after, I think Christmas was on. No, Christmas was on Saturday. It was a Sunday driving out of LA, and a
Oh my
huge
God.
rat ran across 7 lanes of traffic, like a big fat rat. And I'm thinking, there's either so many rats where it was living, I got to go find food. That's too much competition living in the middle of this freeway. I got to run across it and just risk my life. Or it knew it's like 3:00 in the morning, high noon in LA, and 3:00 in the morning,
Jeez.
rats are running across I-5. That doesn't happen. There's something going on. Yeah, people are staying home out of fear, or there's a lot of hospitalizations.
Well, thanks for that story. I think that wraps it up, guys. Thank you for listening. If you're not a subscriber, follower, like, comment, follow. Get this message out to the world. As always, it's a pleasure being with you, and look forward to connecting with each and every one of you in the future.